Hi, in this video, we're going on a trip from the USA to Ireland, then to the Netherlands, and finally to Bermuda. But we're not here to explore landmarks or try local food. Instead, we'll look at how the laws in these countries allowed Apple to save billions in taxes. We'll dive into a scheme known as the double Irish with a Dutch sandwich, which allowed Apple to avoid paying a massive amount in taxes while remaining unpunished. Let's start with the basics. What is corporate income tax? Corporate tax is the money companies pay to the government from their profits. Every country has different tax rates. Some are high and some are as low as 0%. In Ireland, the corporate tax rate is just 12.5%, making the country one of the most favorable for business in Europe. So Apple set up two firms in Ireland. The first one was Apple Sales International, ASI, which owned all Apple patents and technologies outside the United States. When iPhones or MacBooks were sold in Europe, Apple in different countries, like Germany, would buy the rights to sell these products from its subsidiary in Ireland. On the surface, this seemed like a normal business transaction, but in reality, the money simply moved within the same corporation, and the profits from sales in high-tax countries like Germany, France, and Italy flowed into Ireland. But that's not all. The profits collected by Apple Sales International didn't stay in Ireland. They were transferred to offshore accounts in Bermuda, where the corporate tax rate is 0. How did this work? Until 2015, Ireland had a law that allowed companies to be registered in the country, but not be considered its tax residents if their management and control took place abroad. So, Apple registered Apple Sales International in Ireland, but managed it from Bermuda. This allowed the company to avoid paying taxes in both Ireland and other countries by funneling profits into tax havens. The second company was Apple Operations Europe. This firm handled actual operations, including product assembly, logistics, and sales in Europe. Since this company was involved in physical activities, its profits were minimal and taxed at Ireland's low corporate rate. But that's still not the end of the story. To make the whole system even more efficient, Apple used a tax loophole called the double Irish with a Dutch sandwich. The idea was that profits from Apple Sales International were routed through the Netherlands before being sent to offshore accounts. The Netherlands acted as a transit point because of its favorable tax treaties, allowing Apple to avoid additional taxes when moving money out of the European Union. These tax treaties allowed Apple to avoid double taxation, meaning it didn't have to pay taxes both in the country where the profit was earned and in the country where the money was transferred. By structuring its operations this way, Apple was able to legally minimize taxes while remaining compliant with international and local laws.